Hi, welcome to Let's Talk Forex. I'm Alison, and as always, I'm joined by my co-host, Chris. Hi, Chris.
Hi there, Alison. How are you today?
Yeah, very good, thank you. I'm very excited for our episode today.
I know, we've been trying to do this for a few weeks now, but we got there in the end.
Yes. So as I said at the intro, we're very excited because today we are joined by Michael Brown. He's the Senior Research Strategist at Pepperstone. So welcome, Michael.
Good morning. How are you doing? It's nice, as Chris said, to be finally doing this. We've had TV interviews and power cuts and goodness knows whatever else get in the way. So nice to finally sit down and have a conversation.
Yeah, thanks for coming on, Michael. It's really good to finally get you here.
No, my pleasure.
How's the weather in the UK?
Well, do you know what? It's we have just had an absolutely glorious week, 25 degrees, sunshine, beers by the river, all the rest of it. And then in true UK fashion, it was a bank holiday weekend just gone. And bank holiday weekends are always marked by a downpour somewhere or other. And that's exactly what we've had. So we're back to, 12 degrees and grey skies now, which is your classic UK summer, really.
Absolutely. This is why I left, Michael. This is why I left.
Well, at least we've got power, Chris. So I'll take this side of the trade, to be honest.
Fine, touche, absolutely. But yeah, like Alison said, it's really good to have you on, Michael. And thanks for joining us. And I think we're going to be have a fairly wide-ranging conversation today. But I think we're going to kick off with a little bit about yourself.
Yeah, I mean, on that note, can you tell us basically how you started your trading journey? And, what advice do you have for aspiring traders, I guess?
Blimey, if we'll get the boring bits out of the way first, shall we? Talking about me. So I've been in financial markets in one way or another for getting on for a decade now. It's always something that's been, I've been sort of surrounded by. Various family members have been involved in markets. I've always had, a kind of keen interest in economics and all the rest of it. So, doing this for work is quite fun 90% of the time. But yeah, in terms of like a very brief overview of my sort of market journey, I'm sure we'll go into this in a little bit more detail. I started on the dealing desk of a foreign exchange firm called Caxton, did various dealing roles there for 3 or 4 years, then moved into the research function to run the research function there, and then moved over to Pepperstone probably about getting on for 2.5 years ago now, if not slightly longer. So seen quite a lot in that time. I think it's difficult to pin down a period in that decade where things have been quote unquote normal, been a relatively volatile period to say the least. But yeah, in terms of, people wanting to get started, I'm sure we'll get into this as well. There's I think the one thing that I would say is there's plenty of resources out there now, whether they be the written word, whether they be videos, whether they be webinars, or even whether they be, technology based. And that ranges from something as simple as a paper trading account all the way through to all of the various AI bits and bobs that now exist. So, if anyone is looking to get involved in financial markets, avail yourselves of all of those resources to the fullest possible extent.
Yeah, I think that's very good advice.
Yeah, it is. There's so much out there these days, as you say, Michael, to get started with, and it's not like, and that's a relatively new thing, as well. I don't think younger traders, younger people listening to this realize that 15, even 10 years ago, it was quite a different landscape to get started in trading.
Yeah, no, absolutely. It's not as sort of a dark and mythical and unknown world as it once was, where you're sort of having to sit on a desk and learn from the bloke next to you and just almost act as a sponge and soak up what's being said. As you say, the volume of resources that is out there these days is actually staggering, to be honest. So yeah, I'm not going to sit here and claim that financial markets are easy or trading simple or anything like that, because it's not. But what I will say is that there are ways and means of making things more straightforward than perhaps they would have been, as you say, 10, 20 years ago.
Yes, indeed. So you said you started your career at Caxton's. I don't think it'll be a familiar name to a lot of our listeners. Can you explain to our listeners who Caxton's are and what they do and what your role was there at the beginning?
Yeah, very briefly, without giving too much free promotion to my former employer, which I'm sure they'll be very pleased about nonetheless. They are, they still are. I said they were, they still are a foreign exchange risk management firm. So the focus of the firm really is managing all of the risk associated with large foreign exchange transactions, mainly for corporates and institutions. So, classic example would be company operating overseas. They're based in the UK. They have sales in the United States. How do they mitigate the potential impact of volatility in the sterling dollar or the cable exchange rate on their revenues and on their profits? And the focus of the firm, and there are many such firms like it here in the UK, is to implement strategies that can help minimize or even eliminate the volatility associated with that, to effectively make things much more predictable for those corporate clients. And in terms of my role there, so originally on the dealing desk, managing a book of clients, so involved in those day-to-day transactions that I just mentioned, and implementing those strategies that we were just talking about across primarily G10 foreign exchange. And just by virtue of the UK's trading relationships, the bulk of the business was either cable or euro sterling, just because of how the UK has evolved over the years. And then after sort of 3 or 4 years of doing that, I moved on to the research desk to focus away from the kind of day-to-day sales and trading side, and much more on the underlying drivers of financial markets, and communicating to clients and media what's going on, why it's happening, and what's likely to happen next, which is what I'm still doing now, but just under a different guise.
Yeah. And you started there in junior, but you moved up really quickly by the looks of your career progression. What did you realize quite quickly that you loved the work?
Yeah, absolutely. I mean, as you say, it was a pretty quick progression. I think there were a few things that sort of benefited that, but one of the things was timing. Ultimately, I mean, we're talking here, just before and just after the Brexit referendum back in 2016. So of course, anyone who was involved in financial markets, or really anyone just who was watching the news back then, will know, how ridiculously volatile sterling assets were at the time. And that volatility, whether it be speculative or more conservative market activity of the like I was dealing with, it does result in increased business. And I think that was probably one of the reasons why I was fortunate enough to progress pretty quickly up the ranks.
What was the most challenging market situation you found yourself in when you were working there? I know, as you say, there've been a lot.
There have been a lot. I was asked this question by someone else recently, actually, and it's always hard to sort of pinpoint what the most challenging thing was, because I'm not going to give a politician's answer, but whenever you're dealing with a challenging situation, whether it's Brexit or some of the more recent turmoil we've seen in the States, which I'm sure we'll get onto later on, you naturally think that, oh my God, this is the worst situation I've ever dealt with. This is the biggest challenge in the world, et cetera, et cetera, et cetera. I think the weirdest situation was undoubtedly COVID. And I think I'd also say that it was the most challenging, because it wasn't just a case of dealing with sort of run-of-the-mill market stuff. Ultimately, if you're dealing with, let's say, a sell-off in risk assets, or a dash for the dollar, a bit of a funding squeeze, whatever it may be. Yeah, it's challenging, and it's an interesting time, and it's volatile, but it's also relatively normal. The issue with COVID was that you've got all of the market stuff going on, but then you've also got the fact that you're sat there hunched over a laptop at your kitchen table using Wi-Fi that's a little bit dodgy, while someone else is trying to stream Netflix, and you're worrying what's going on in the market. So I think COVID was the biggest challenge, because you've got not only markets being turned on their head, but the economy being turned on its head, and actually just the way in which we live and work being turned on its head as well, and trying to, I think this is the same for everyone, trying to work your way through that was a bit of a nightmare, to be honest. But we got through it, we survived, and here we are 5 years later, remarkably. It feels, almost like yesterday.
Yeah. No, it does, doesn't it? Yeah, COVID was such a weird time, I think, for everybody. And as you point out there, I think the personal aspect was probably the most challenging for everyone. So after you were in the dealing desk at Caps and you moved into, as you say, into a research role, what drew you to the role? Was that a natural progression? or was there something about it that captured your imagination?
Yeah, I mean, to be completely honest, it was more of a sideways step than a sort of upward step at the time in terms of how company hierarchies work and all the rest of it. I think what sort of really drew me to the role was I'd been at the coalface, for want of a better word, of financial markets for a period of time at that stage, and to realise that actually what I'm really enjoying here is not necessarily the day-to-day sales and trading side of things, but more the why is the pound doing what it's doing? What is the Bank of England going to do next? And those sort of conversations were the ones that I was enjoying much more than anything else. So when the opportunity came up to, rather than sort of doing that on the side as a bit of an extension of the day job, when the opportunity came up to actually make that the day job, I'm kind of sat there going, actually this is sort of right up my street, and something I'd like to throw my hat in the ring for. And thankfully it seems to have worked out okay, and I think I made the right choice.
Yeah, I think you have. I mean, was there less stress involved as well? I mean, I imagine working on the dealing desk could have been was a bit of an adrenaline ride sometimes.
Yeah, I mean, yeah, a little bit less stress, but I think probably stress in a different way. Rather than running a book of risk, you're fielding calls left, right, and centre from people who are now going, you're not just the man who's executing my trades. You're now supposedly the expert who's going to tell me what's going to happen next. So yeah, maybe not the financial stress or risk, but yeah, certainly not a zen job by any stretch.
And I can imagine, actually, now that you put it that way.
Your role at Pepperstone was quite different to what you were doing at Caxton. Your role at Pepperstone now.
Yeah, I mean, in some ways, no, it's very similar, because a strategist role at one shop is going to be very similar to a strategist role at somewhere else on the street. But there are a few sort of significant differences. I think the first is the size of the firm. Pepperstone is a much bigger firm than my previous employer. We operate globally across. Yeah, I mean, we've got offices pretty much everywhere at this point. I won't list them all out because I'll undoubtedly forget one of them. So that brings its own challenges, both in terms of collaboration internally, but also in terms of dealing with clients across the globe, across time zones, etc. We also deal with a much bigger range of products. So whereas previously my role was, centered primarily on foreign exchange, although of course, we all know that the foreign exchange market is driven by pretty much everything else. Here at Pepperstone, we actually actively trade and offer those other products. So you need to have a much, much deeper understanding of them. And I think that's probably the other difference that I would say is that you're dealing with a very different end of the market. As I said, the focus of Caxton, my previous firm, was very much on risk management and minimizing the risk involved and dealing with, frankly, quite risk-averse stakeholders, be they, chief financial officers or managing directors of large corporates. Whereas, I've almost moved to completely the other end of the spectrum where, obviously risk management is important, but in a different way. Our clients are not looking to minimize volatility. They're looking to extract ways of potentially profiting from that volatility. So that sort of psychological shift was a significant one as well. So I think they're probably the three main differences. But besides that, market and macro strategy is market and macro strategy at the end of the day.
And what's your favorite part of your role at Pepperstone?
Well, it's certainly not the 6 a.m. meetings or the 5 a.m. alarm calls. I can assure you of that. I think the favorite part of the role would almost certainly be the interactions that you get to have with clients. I think one of the things that, whether they be in person or over the phone or Zoom or whatever, one of the things that I really do enjoy about the job is when you're putting an opinion across, or you're putting your view across, and actually someone says to you, well, hang on, mate, I think X, and it's the polar opposite of what you've just said. Because firstly, it takes two to make a market, and everyone's view is as valid as another. But secondly, because that actually makes you question your own assumptions. It's all very well for me to sort of stand here on my soapbox and say, oh, the dollar's going to do this, and Trump's going to do that, and that's going to do Y to the equity market or whatever. But actually to have those assumptions challenged by someone else, that's when you really have to be sharp and on your toes to say, either actually that's a really valid point and I think I've got this wrong, or that's still a valid point, but actually here's why I think that I'm going to be right. And I think it's those interactions that are the most rewarding part of the role.
How big is the research team at Pepperstone? And I mean, you mentioned your offices all over the world, but do you have research analysts? Like, I mean, are you also spread all over the world as well?
We are, yeah. So we've got 5 or 6 of us now, covering all sorts of regions. So myself, primarily, I will cover Europe and the US, just because obviously being based in London, they are the easiest markets and easiest time zones to be covering. We've then got folk in the Middle East. We've got folk located in APAC. We've got guys in Latin America, and we've also got Melbourne, of course, as well, which is our head office. So yeah, we've got quite a lot of coverage globally, both in terms of geographical markets, but also in terms of local languages as well.
Amazing. So there's always somebody up watching the markets.
Yes, absolutely. And well, probably 9 times out of 10, that will be me as well.
Well, if you're up at 5, then I'm not surprised. And so, what does your daily role entail? Can you walk us through like your day to day?
I'll be honest, I really hate this question because I have to now use the cliche that no 2 days are the same, which it's a massively overused statement, but it is very, very true. Yeah, I mean, there are some things that you do every day. So, for example, my daily commentary that goes out, early doors. That's a something that's written very early in the morning to sort of summarize everything that's happened over the last 24 hours or so, and my latest sort of views and opinions on markets, and frankly whatever else I fancy talking about that morning. There's also various sort of briefing calls, whether that be sales or media or whatever it may be, around key things to look out for over the course of the day ahead. But then beyond that, I mean, it really does vary day to day. I mean, we may be doing television appearances, talking about our views on various business TV channels. There'll be plenty of client conversations happening, whether that be sort of market specific or more educational in nature. There may be events going on. We do quite a lot with our clients, whether that be things like lunches or seminars or whatever it may be. Podcasts like the one I'm doing today. It really does sort of vary day to day. I mean, and then of course within all of that, there is some time where you're sat at your desk going, okay, well, in 10 minutes time, we've got, NFP out of the States. What the hell do we think is going to happen with that? And, digesting the data. And of course, nowadays, the tweets or Truth Social posts from President Trump as well, which could, of course, come at any time. So, yeah, quite varied. And you don't get much chance to put your feet up or to get bored, which is definitely something that I enjoy. I don't want to be sat there sort of twiddling my thumbs all day.
No, it does. I mean, like you say, it sounds very busy, but also quite fun, I think.
Yeah, absolutely. And in those sort of small moments where you do have I don't want to use the Q word, but calmer markets, then yeah, absolutely, you do get a chance to have a little bit of fun in the middle of all that as well.
Our podcast obviously focuses on beginners getting a good start to Forex trading and their trading careers. Can you talk a little bit about Pepperstone's, what they offer beginners in terms of their market analysis and educational materials? I mean, I love watching your stream on and your webinars that you do. How often do you do them, Michael? Sorry, I've watched a couple of them. And I know Chris Weston also does like a daily fix, and then Mark Holstead has his webinars, I think once a week. So what is your schedule? What do you offer beginners beyond that?
Yeah, we've got a lot of content, to be honest with you. So both Westy and I, Westy obviously being Chris Weston, will do daily research notes. And I think one of the good things about having a Melbourne office is we almost sort of bookend either side of the day, whereby I'll be writing my commentary at 6-7 o'clock in the morning and putting that on the website and social media and emails, and then obviously Westy will sort of be starting his day just as the US market closes. So you get that view right at the start and also right at the end of the trading day, which I think is quite helpful. Although obviously I am slightly biased as to which of those notes will be the better read. In terms of other bits and bobs, we so I can't talk about Westy without getting a dig in. It's the rules. He'd do the same to me. In terms of other bits and bobs, we do pretty regular videos that go up on our YouTube channel, both in terms of market updates. We try and put out as a desk sort of 3 or 4 of those a week, depending on prevailing sort of market conditions. We've also got various educational videos that go up. I think they usually go up on a Tuesday and a Friday, but do forgive me if I've got that wrong. And I think most of those are also run in the form of webinars as well. So the video is essentially a recording of the webinar. If you join the webinar live, then obviously get the opportunity to ask the presenter various questions and ask them to expand on points, etc. And then in terms of the written word, then there's plenty of content on the website as well. A lot of educational stuff, and actually over the last 6 months or so, we've undergone and are still undergoing a big effort to expand the amount of educational content on the Pepperstone site. So that ranges from very simple things around the basics of foreign exchange or the basics of commodity trading, through to slightly more complex topics around, for example, the idea of how to place a trade over non-farm payrolls, or what to watch over an FOMC decision, all that kind of thing. And again, we're uploading 2 or 3 articles a week to that section of the website as well. So yeah, plenty of content out there, and also of course both Westy and myself and the rest of the desk, I'd like to think we're pretty approachable, be that on social media or wherever else. So if anyone has a question that isn't covered by all of that, then absolutely more than welcome to reach out and give us a shout, and we'll try and help you out.
Yeah, fantastic. We'll put some links in the show notes to how people can get in touch with you. I assume you're active on Twitter, or X as it's called now.
I think most people would say far too active, but yes, I am.
But yeah, that's great.
I think where a lot of beginners struggle is, as you said earlier, there's so much content out there, but sometimes I think it becomes so overwhelming that people just don't know where to start. You want to go sort of from A to B and have a process, to get there. What advice would you give beginners that are getting started in their trading career? I know it's not an easy question to answer, and it's not a straightforward answer, but if you could do your best.
I was going to say it's not an easy question at all, so thank you for that. I think I would preface it by saying, as we said earlier, it's not easy. Trading is not something where you can sort of one day sit there and go, I want to trade, and then the next day you're an expert and you're consistently a profitable trader. I mean, I will happily sit here and admit that even after a decade or so in the markets, there are still things that I see where I go, I don't quite understand that, whether it be a headline or a market move or whatever it may be. You are very much learning all the time. And I think if you ever get to a point where you're not learning, or where you think you're not learning, then you probably need to reassess things and take quite a deep look at how you're doing things. But in terms of getting started, I think the sort of overarching advice I would give is, to me, it's really important to certainly don't have any illusions about what you're getting yourself into. This is a difficult game, as we said. You undoubtedly will lose money, and you probably will end up, having to deal with that, and having to deal with that psychologically. So don't be sort of lulling yourself into a full sense of security on that front. In terms of actually trading, though, I think having a focus on a couple of instruments at the very most is important for any trader, but especially for beginner traders. I mean, you see quite often someone going, I want to start trading, and all of a sudden they've got positions in, a couple of foreign exchange pairs, gold, the S&P, and a random commodity like coffee. It is impossible to have an in-depth understanding of how all of those markets work and how all of those markets are trading at the time when you have those positions on. So really narrowing that focus down to a couple of instruments, whether it be cable and euro dollar, the most sort of liquid FX pairs, or you want to trade just the S&P 500 and the Nasdaq 100 in the United States cash session, for example. But really narrow that focus down, because that will allow you to properly understand the dynamics of those markets, how they move, why they move, even the sort of microstructure around who might be involved at certain times of the day and this sort of thing. Don't try and be a sort of jack of all trades, because you will end up being a master of none, to use the famous saying. Really have that focus on a handful at most of instruments. I think obviously having a strategy is important, but more importantly than having a strategy is firstly sticking to that strategy, and secondly reflecting on that strategy. And I know everyone says it, but journaling is very, very important. Now, a lot of people get the wrong idea about journaling and just have an Excel spreadsheet or a notepad, and they just write down, where they opened a trade, where they closed a trade, and what the P&L was. To be completely honest with you, that's pointless for a journal. You've got your trading statement for that. The journal should be around, why did you open that trade? What did you see in the market that caused you to open that trade? Why did you close the trade? What happened while that trade was open? Did you get close to triggering the stop? Did you have to move the stop? Did you move it down? Did you move it up? All of these things, which then in a month's time, when you've built up that body of data, allows you to go back and go, well, actually, on the last 5 losing trades, it's all been because my stop was placed too close to the entry, or whatever it may be. But because you've got that anecdotal commentary around the trades, it allows you to then improve your strategy. So journaling is very, very important. And, that can be as easy as, doing it on an A4 bit of paper or in a notepad. You don't need anything more complicated than a pen and paper to do that. And I think the last thing I would say is, and again, this is, sort of advice that is frequently given, but you need to be able to remove emotion from the process as much as you possibly can. That is very much something that is easier said than done, but you should be trading based on the strategy that you have decided upon. You shouldn't be trading based upon, hope or despair or anything like that. And as a sort of extension to that, and a very last point on this, I know I've rambled on a bit. There is absolutely nothing wrong, or there's no problem with just taking some time away from the desk. If you are looking at the markets and you don't see a trade that you like the look of, well, go and do something else. Go and do some life admin. Go for a walk, whatever it may be. If you've had a losing trade or a run of losing trades and your head is not in the right place, again, leave the desk. There is no harm in doing that. And actually, I think it's much better to do that and take some time to reset psychologically and physically. It is a taxing task to be focused on markets all day long. There's nothing wrong with taking some time away and then coming back in a much fresher and better mindset. And I think that will serve people better than just sort of sitting there and mentally getting worse and worse and worse. So yeah, I appreciate I've gone on a bit there, but I would say they are sort of the general hints and tips that I would probably give.
No, that's fantastic, Michael. Totally agree with you.
Yeah, and it dovetails so much with what we talk about as well, Alison, which I find really fascinating. The importance of journaling, the importance of taking breaks, the importance of focusing on a few assets rather than as you say, going whole hog into all kinds of things. You mentioned there are a couple of instruments, the cable and the euro dollar. Would you recommend those as good places to start for beginners who are just specifically interested in Forex trading?
Yeah, I mean, I'm not going to sort of make any recommendations or advice as to, what people should trade and what they shouldn't trade. I mean, I think, in terms of, if you are someone out there who wants to trade foreign exchange, then naturally you should lean towards the most liquid and the most actively traded pairs. So you naturally fall in the G10 space, and by extension, you will probably end up with either the euro, cable, or dollar yen. if you're an Asia-based trader, then obviously it makes more sense to be trading dollar yen than it does something like cable, just geographically. But it very much depends on where someone is coming from, what they want to trade. I think that's very important. There's no point, me sitting here going, you really should trade the euro if someone is only interested in trading equities. But it also depends on someone's background. If you have, for example, experience in the equity market in some way, shape, or form for a previous life, then it makes much more sense for you to be trading equities than it does for you to be trading currencies or trading foreign exchange. So yeah, it very much depends on the person involved. But if you are looking to trade foreign exchange, then those most liquid G10 pairs are absolutely the place to be starting, I would say.
Yeah, definitely something we recommend as well. So I just want to jump a little bit into something that you enjoy talking about. Well, I wouldn't say more than trading strategies, but into the markets, Michael, if you don't mind. Obviously, Trump has now been president for well over 100 days. I think we hit that landmark a couple of weeks ago, last week. But if you're listening to this podcast, it'll be, I think, 2 weeks ago. And there were a lot of rumors flying around about, what he was going to do before he entered the office. Have his actions sort of met your expectations at Pepperstone? Is this what you thought was going to happen? What we've been seeing in the markets recently?
Yeah, well, I mean, firstly, 100 days, I think it's felt like about 100 years for most of us that have been involved in markets over that period of time. It's been, the amount that has happened is staggering, to be completely honest with you. I mean, I'm pretty sure that there's stuff that's gone on that we've completely and utterly forgotten about just because of the volume of news that the Trump administration has created. I'm absolutely not going to sit here and say that, we called everything absolutely spot on, because frankly we haven't, and I don't think many people have, particularly when it comes to the market reaction to tariffs, of course, that were announced, the reciprocal tariffs. If you're watching, you can see me doing the little inverted quotes there, that were announced on the 2nd of April and then unwound again a week later. I don't think anyone was predicting the reaction to that, and certainly the tariffs themselves were considerably more aggressive and more sizable than we've been expecting. But one thing I would say in terms of Trump, and I think this is where a lot of people get Trump wrong, and I'm not going to get political here by any stretch, but one thing with Trump that is different from almost every other politician out there is that when he says something, whether it be in a rally or a news interview or an article, he goes and does whatever he's said. And the issue of trade is a classic example of this, because you can go back to interviews that Trump was giving in the 80s and 90s when he was a real estate developer in New York. And in those interviews, he was talking about how Japan was ripping off the United States, how Germany was ripping off the United States, how tariffs would be able to rebalance it. So, this isn't something that Trump's just sort of thought up one afternoon and written on the back of an envelope and given a speech on. This is actually something that he's been, talking about for the bulk of his life, and now he's got the chance to actually implement it. So I think a lot has happened. A lot of it we didn't predict, but also at the same time, while the delivery of the policies has been very uncertain, very volatile, and frankly quite incoherent at times. I mean, I think one point policy towards Canada changed 6 times in 7 days or something stupid, which is just frankly laughable. At the same time, there is an element of predictability around what's going on. It's just that element is much, much smaller than I think pretty much every market participant would like it to be.
What is the most unexpected sort of policy change that's come about for you? What was the biggest surprise for you guys?
Oh, crikey. I think genuinely, the biggest surprise, personally speaking, was that Trump paused the reciprocal tariffs a week after he introduced them. And I distinctly remember, I think it was either the Friday after he announced them or the Monday morning of the week when they were put on pause. I distinctly remember him making that very point in a note around, this is something he's been going on about for 4 decades. He's not going to tear it up after a week. And well, then he did. So, but I think that was just a sign of, clearly the administration, despite what they say, they are paying attention to the moves that we're seeing in financial markets. But I think that was probably the biggest surprise. I think also just the extreme lengths that we've now gone to on trade, where we've effectively got a trade embargo between the US and China. I don't think anyone was predicting that, and also it's been surprising how easily financial markets have sort of shrugged that off. To be completely honest with you, I mean, you look at the S&P, we're back where we were at the end of March. If you were living on Mars for the entirety of April, you'd sort of land back on Earth and go, well, what the hell was all the fuss about, guys?
I mean, you mentioned there, that he backed down from his Liberation Day tariffs, and except as you pointed out there in the case of China, he's repeatedly backed down. I mean, there was before the Liberation Day these reciprocal tariffs. I mean, there was Mexico and Canada, which he's backed down from, and I'm seeing a new acronym float around now, which is the TACO acronym. I'm not sure you've seen this. That Trump always chickens out. Do you think these tariff threats, I mean, because he keeps on backing down, do you think these are more of a negotiating tactic? And especially you can see now with the overtures to the Chinese over the recent weeks. Do you expect in the long term these higher tariffs are going to come through, or do we see them more as a negotiating tactic that are then going, after negotiations are going to be repealed, and they will end up with a much lower tariff level?
Yeah, it's a difficult one, because I think we've actually moved from the stage where tariffs were a negotiating tactic to one where they are now a sort of actual, real policy tool. And the reason I say that is because, as you said, the sort of January, February period where we had these tariffs on Canada and Mexico as a result of, well, supposedly due to fentanyl, that was very much a case of, from Trump's point of view, I want to get the Canadian and the Mexican governments to the table to have a conversation. I think we've moved on from that point now, and I would point to the negotiations that are ongoing at the moment around all of these trade deals. This supposed idea of 90 deals in 90 days, which by my maths is currently running at 0 deals in 3 weeks, which, to be honest, doesn't have quite the same ring to it, but there we are. A lot of the sort of sources reports that are coming out of these negotiations very much point to the idea that because you've got to remember the reciprocal tariffs that were announced on the 2nd of April, they had this baseline 10%, and then this frankly nonsense maths formula that was used to calculate an additional levy, and then you put those two together, and that's the tariff that was being charged. Now, all of these discussions that are going on around deals, the reporting is, and if you believe it, of course, is that the baseline 10% is going to remain in place. Now, if this was purely a negotiating tool, then the baseline 10% would also be on the table for removal. So I do think there's a degree of, we want to level the playing field. We want to get manufacturing jobs back in the United States, et cetera, et cetera, et cetera. But I also think there is a degree of, the Trump administration do seriously see these tariff policies as a way of generating revenue for the United States, which is why they'll leave that baseline 10% in place. So it's almost a sort of have your cake and eat it trade policy, which I've got to be honest, I'm not convinced in the long term that will work. And of course, then the issue of China is almost a completely separate one at this moment in time. I mean, I think everyone knows that 150% tariffs on both sides of that equation are, quite frankly, unsustainable. The question is really who blinks first. Neither side is going to want to swallow their pride and pick up the phone and call the other. But at some point, I think they're going to have to, and I think we all know that situation is unsustainable. The issue is even now, with a 10% tariff on imports and this 100% on China, the average tariff rate in the US is still well above 20%. And even if you brought China down to the level of everyone else, you're still dealing with a tariff rate in the sort of mid-teens. And those are still multi-decade highs. So even if we get trade deals, even if we get some of these tariffs permanently removed, it's still a very, very significant economic headwind for the US to be dealing with.
Just in terms of, investors have obviously been spooked, but as you say, it's quite surprising what's happening in the markets now, that they seem to be recovering very well. I mean, look at the last 15 days and it's been extraordinary sort of growth. Traders obviously thrive on this volatility, but how would you suggest? I mean, other than obviously checking out the headlines, how would you trade in these sort of environments? I mean, the charts have been really ugly, to say the least. What is your advice for traders trying to trade?
It's a really hard environment to trade in. Yeah, I mean, trading is not easy at the best of times, but certainly the last sort of 6 weeks or so has been a very, very difficult environment. Whether you be a complete novice trader who's placing your first position or the most experienced man on the street, it has been very, very difficult. And I think the reason for that is because, primarily speaking, the traditional tools that one would use to formulate trade ideas, things like relative growth divergence, relative central bank differences, whatever it may be, or even more technical tools such as moving averages and things like that. They simply have not worked. And they do not work in this sort of an environment where you have such significant policy shifts happening at a moment's notice. The way in which you would typically trade does not work, and that is where it's important to be agile. There is absolutely nothing wrong with simply sitting there saying, I cannot trade this market. Rule number one in a fast, volatile, choppy market like we see is, in fact, in any market, is protect your account, protect capital, live to fight another day. And if the way you live to fight another day is by not trading at all, then that is absolutely fine. There is no reason or need to feel embarrassed or inadequate about that. If you are going to trade markets like this, then the sort of standard operating procedure for a volatile market has to come into effect. Reducing position size, lowering leverage. They are the two obvious levers to pull. It's also a case of, you really need to be considering, where are you placing orders? If you usually place a stop in a certain position, that probably needs to be quite considerably wider, given the higher levels of implied and realized vol that we are seeing, and your position size obviously needs to be adjusted to accommodate for that. So there are ways and means of adapting to a fast, volatile market, but it's certainly not easy. And even your best laid plans can and will go awry, as we saw when Trump did make that reversal on reciprocal tariffs. And I vividly remember I was sat at my desk at home. I'd turned to my phone to look at the Truth Social post that he'd put out, and that probably took me 10 seconds to read, if that. And by the time I turned back to my screen, I think the S&P 500 was about 7% above where it was when I turned away. Now, naturally, there are a few expletives there that I shan't repeat on this call, but that just gives you an idea of how rapidly markets have been moving. And it's a situation that we're all having to get used to, frankly, even though, of course, things have become marginally more subdued of late. There is every potential that, and in fact, I do think that volatility is probably going to come back with a vengeance. I think markets have probably become a little bit too calm, in my view.
I guess it's also a question of looking at fundamentals versus technicals. A lot of traders are saying this is quite a technical market to trade at the moment, because also I find the headlines sometimes don't make sense. Sometimes it just doesn't do what you think it's going to do, based on the commentary coming out of the US and whatnot.
I think the really important thing for market participants at the moment, even more so than it would usually be, is to understand, firstly, what the market has already discounted or priced in. So for example, has the market already priced in some small probability of a trade agreement with China, or of President Xi and President Trump speaking on the telephone? Where is the market sitting in terms of its current assumptions? Obviously, I'm using the market as a coverall term for every trader and participant. And I think the other thing to ask is, what is the market looking for? Is the information that we're getting new, or is it stale? For example, if, and it hasn't happened, but if while we're recording this, a headline came out and said something along the lines of, Commerce Secretary Howard Lutnick thinks that trade deals might happen this week. Well, to be completely honest with you, Mr. Lutnick has been saying that for about 4 weeks now, every single day. So naturally, that is not going to massively move the market, because everyone's going to kind of go, well, fair enough, that's old news. We know you're hoping a deal comes, but I'm hoping I win the lottery. It doesn't mean it's actually going to happen. So there's an important point around having that feel for financial markets, and this comes back to what we were saying earlier around sticking to a handful or a couple of instruments, because then that will enable you to get that feel for what is this market really reacting to, what is priced in, what are participants thinking, etc., etc. I think that's pivotal anytime, but certainly when you're dealing with a situation as fluid as the current one.
Yeah. Just changing tack a bit. Well, not that much, but a little bit. I just want to talk about the dollar. We've kind of danced around the subject a little bit, but I wanted to talk specifically about interest rates and where we see the dollar going. What's happened to the dollar in recent months? Trump has made it clear in recent weeks that he wants to lower interest rates. I mean, he's been saying this even before he was elected, that he thinks the Fed keeps rates too high. The Fed, on the other hand, have made it clear that they're independent from Trump and that they are happy to wait and watch, which I think most sane observers will agree with. They're worried about how these tariffs can impact inflation. Where do you say interest rates going this year? I know we've got the Fed meeting tomorrow. Jay Powell and others have made it clear that they're probably going to wait. I think the markets have not priced in any move in interest rates until July. What are your thoughts on this? And more broadly, do you think considering recent comments by Trump and by his member of his administration, I think Kevin Haslett, do you think the Fed independence is genuinely under threat?
Yeah. Okay. So quite a lot to unpack there. I mean, obviously, your listeners will probably hear this after the May FOMC, but I'm very well prepared to say that they will not have done anything with interest rates. That's simply off the cards. I think the Fed have an issue because their goal, as given to them by Congress in the United States, is to do two things. One is to ensure maximum employment in the US economy, and the second is to ensure that prices remain stable. Now, they broadly define maximum employment as an unemployment rate somewhere between sort of 4 and 4.5%. Of course, stable prices is broadly defined as inflation at or close to 2%. Now, the issue with the trade policy of the Trump administration is that it poses significant risks to both of those goals, but in opposite directions. So obviously, tariffs come in. We all know that eventually tariffs are paid by the consumer because they are passed on in the form of higher prices. That means that inflation is likely to move higher. Of course, at the same time, because of the tariffs and the higher prices, you're probably going to see a drop in demand as a result of that, and also the various other issues that tariffs pose in terms of the supply chain and transportation and logistics. You're likely to see economic growth slow and unemployment rise. So we would coin the term stagflation to describe that scenario. But what it means is that actually the economy is at the same time moving away from both of the goals that the Fed has been given. Now, the absolute last thing that they would want to do in that sort of a scenario is to lower interest rates, because that would merely serve to actually exacerbate the issue and send inflation even higher. And actually, perhaps counterintuitively, the more times Trump says, I want lower interest rates, the less likely it actually becomes, because, of course, the Fed run the risk of looking like they're just sort of being obedient to what the president says. And that's the last thing they would want to be doing. In terms of where rates will go, I think the direction of travel for rates remains down, it remains lower, and rate cuts are still on the horizon. I think the Fed are, though, firmly in what you would call wait and see mode for the time being. They are going to want to make sure that they have enough data to be reassured that any upside inflation risks brought about by tariffs are going to prove temporary before delivering any further rate cuts. So I think anyone expecting cuts before the summer is out that's a very, very long shot in my mind at the moment. You're probably, given where things are currently, looking at either the October or the December Fed meetings for them to resume that easing cycle. But I think the bigger issue among all of this is obviously that matter of Fed independence, as you said, and as I said, Congress say to the Fed, these are your two jobs. The president appoints the Fed chair and appoints members of the Fed board, and then they are given independence to go and get on with those jobs and set policy in the way that they see fit. Now, my concern over Fed independence is not necessarily around what's going to happen to Jerome Powell, who, by the way, I think has done an absolutely brilliant job in his 8 years at the Fed. I think Trump, although he was on the verge of it, I think he has now decided that he's not going to remove Powell from his post, primarily because he actually has no legal way of doing that. But secondly, because he is going to be able to replace Jay Powell in May of 2026. That's when his term expires as chair. Now, this is where I have a real concern, because firstly, let's be completely honest, whoever is appointed as the next Fed chair in May of 2026, they are going to end up having to be a yes man. They are going to be appointed because they tell the president that they are going to do what he says. Whether that be Kevin Warsh, who is a name that's been mentioned in the press, whether that be Kevin Hassett, who you mentioned a moment ago, or whether that be someone else, I think the main qualification for the job is not going to be, where did you get your economics PhD from? It's going to be, how many times are you going to say yes, and how many times are you going to lower interest rates? So that naturally is going to erode the Fed's independence and also their credibility. I think the other concern I have, and this is a little bit more technical in nature, is when do they name the successor? Now, obviously, Powell has effectively another year in the job. Past precedent is that we would generally see a name appear sort of January or February before the term expires in the May. In fact, I think that's broadly when Powell was announced. Because, of course, you've got to remember that Trump actually picked Powell to do the job, despite the fact that he now seems to hate it. There is a school of thought, and it's a school that I subscribe to, which says that actually the Trump administration could name the new Fed chair, their pick for Fed chair, considerably earlier than that. There's nothing stopping them from naming who will take over at the Fed in September, October this year, and then saying that they will simply take over when Powell's term expires in May. Now, the potential benefit of doing that is financial markets, of course, are trading on future policy expectations. We spoke earlier about what's priced in, what are markets expecting. Now, if you name someone to be Fed chair in October, so we're talking 7-8 months before they actually have the power to set interest rates, but then simply just send them out to give endless amounts of speeches and media interviews and TV appearances, they can provide guidance to the market in those appearances, and there will be a tipping point whereby market participants pay more attention to the new guy than to the current guy, Jay Powell. And of course, that will, if the message is dovish enough and if there is enough credibility there, that will have the effect of causing treasuries to rally, lowering rates across the curve. It would also see, the market price a much more dovish outlook after May when the new guy takes the helm of the Fed. And I think that's the other thing to be aware of is it's not a question only of who the next Fed chair is going to be. I think the more important question is, when do we find out who they are and how much influence do they have in that sort of transition period?
Fascinating. Yeah, no, really, really good answer, Michael. That's it's something definitely to look out for. So, I mean, would you say, looking at where the dollar's obviously come under severe pressure, and even with the market rally in the United States, the DXY is still down. Would you say, based on everything we've talked about here, do you see this continuing, this situation? Do you see as any kind of support for the dollar in the longer term, or do we think this is a new normal?
Yeah, I mean, ultimately what we saw at the start of October was what you can easily characterize as a sell America trade. As you said, equities coming lower, the dollar coming lower, and treasuries being sold pretty aggressively as well. Yes, we've seen a rebound in the equity market, but I do think that the credibility of the institutions of the United States has been quite severely shaken and significantly eroded by the events of April, but also just the general way in which the Trump administration have been conducting themselves, whereby sort of long-standing precedent doesn't seem to mean particularly much to any of them. I would stress that, if we are seeing, and I do think we are seeing, institutional investors and asset allocators moving out of the United States and rotating and moving that capital to other jurisdictions, whether that be Europe, Japan, or wherever else. That is not the sort of process, particularly if we're talking about reserve allocations, that's not the sort of process that is done and dusted in the space of 3 trading sessions. If this is a sort of paradigm shift, for want of a better word, to a world where the dollar is still the reserve currency, I don't think that's going to change anywhere else, but it is a reserve currency among others rather than the only one. That's something that will take months, if not years, to pan out. So yes, I think it's notable how equities have rebounded. It's notable how the dollar is still sort of languishing close to those lows. But by no means do I think this is a case of case closed and done and dusted. We can forget about the sell America trade. I think that's still something that is certainly bubbling away under the surface and will probably rear its head again, but before particularly long.
Yeah, where you seem to be in a weirdly calm moment after the chaos that we had earlier in the month, and I've seen a lot of commentators come out of the woodwork recently saying, "Oh, the whole sell America thing is overdone. The whole loss of faith in Trump's administration handling of the economy." I have had misgivings about that, and it sounds like you do too. I think maybe there may be a case here where the Trump administration has maybe learned that they were moved too fast and too quickly, and they're maybe putting the brakes on a little bit before. And I think that potentially, that we're going to see over the coming months, maybe a slower, less aggressive move, but still in the same direction than they were moving before.
Yeah, I think that's a reasonable assumption, actually, and I think there is. This is sort of a bit of a pet peeve of mine. I'm going to try not to go on a rant now, but I think there is far too much focus on the intraday market moves that we see. The S&P was up 0.3% today. It was down 0.6% the next day, and it's up 0.3% the following day. I mean, all of that sounds very, very exciting, but ultimately you end the week basically where you started it, at the end of all of that. And I think there is not, amid all of the noise that we have going on in terms of fundamental developments, there's not enough of that focus on the sort of longer run trends and shifts that we're seeing. And I agree that is very much sort of going a little bit under the radar at the moment. But it does feel like an uneasy calm for markets at the moment. I think everyone's sort of been lulled into a little bit of a false sense of security because we haven't heard too much about tariffs for a week or so. But as we alluded to earlier on, all it takes is one tweet or Truth Social post and wallop, we're in the mix again.
Yeah, fantastic. Exactly. I know. I agree with you 100%, Michael. Well, look, we've kept you on for an hour now, Michael, and I don't want to keep you on for much longer. But do you have any final thoughts on where you see markets going, or any advice for traders who are listening to this?
Yeah, I mean, I think my sort of broad views at the moment, and obviously I'll caveat that by saying we're recording this on the 6th of May. I reserve the right to change my mind. Would be to fade upside in equities. I think the market has got far too optimistic, and actually we are seeing things come off the boil a little bit over the last couple of days. I think as we said, the dollar will continue to sort of leak lower for a relatively prolonged period of time. And really, I'm still of the view, actually, and as someone who has never been much of a fan of it, this is surprising, but I'm still of the view that actually one of, if not the most effective sort of hedges to all of this remains gold, and I think the yellow metal should continue to trade relatively well for the foreseeable.
I was going to say, I wonder where the money's actually flowing to, and what the options are. But as you say, gold is definitely rallying very strongly.
Gold seems to be the big winner. Yeah.
It is, yeah, and certainly out of Asia, buying flows out of Asia into gold have been very, very significant indeed, and I think the reason for that is because ordinarily in a time of strife, you would go, well, I'm going to go and buy the dollar. Well, you can't really buy the dollar at the moment because it's frankly the thing that is most exposed to what you're trying to hedge. The yen, well, you could go and buy the yen, but are we talking about the potential for the yen to be involved in trade negotiations between the US and Japan? You don't know. Could you buy the Swissy? Well, yeah, the Swiss franc is a safe haven, but are the Swiss National Bank going to tolerate much further strength in their currency, given the issues they're having with inflation? So really, you kind of go, what is isolated not just from the political risk and the trade risk, but also all of the other risks that are involved. And actually, gold is sort of proving its worth as a diversified asset at the moment.
Real safe haven. Yeah. Thank you so much for joining us today, Michael. It's been really enlightening, absolutely fantastic having you on. And I'm sure the viewers have really enjoyed your insights. So thank you so much.
No, it's been a pleasure. Thanks for having me.
And we'll hope to have you again soon. And we'll put some links, as we said, below in the show notes to where people can get in touch with you. And is there anything particular you want to shout out, Michael, before we let you go?
No, I think we've covered a hell of a lot of ground there. So thanks for an enjoyable conversation.
Superb. And hopefully we'll have you back on again soon.